Welcome to The Explainer. I am so incredibly excited to have you here today. We are going to take a really deep dive into the hidden mechanics of double-digit income streams. Now, if you've been following the markets lately, you've probably noticed this massive surge in incredibly high-yield products catching the eye of yield-hungry investors everywhere. But as we all know, in finance, there's absolutely no such thing as a free lunch. So today, we're unpacking the fascinating and honestly sometimes perilous world of auto-callable ETFs, with a razor-sharp focus on the risk behind their 70% barriers. I want to start off by posing this question directly to you. How exactly do you get a 15% yield without touching junk bonds? It's a genuine struggle, right? I mean, retail investors are constantly hunting for high yields in today's market, but traditional safe havens, they just don't pay out like they used to. And reaching for yield usually means taking on some pretty massive credit risk. Well, think about it this way. The S&P 500 dividend yield is hovering right around a really modest 1.3% right now. But then you look at a structured product like Innovator's ACI ETF, which targets an average coupon of 14.6%. That is a staggering difference. It honestly looks like a magic trick. How on earth are they engineering a payout that is literally more than 10 times the broad market dividend? Well, it's all in the structure. Okay, let's dive into this. Here is our roadmap for today. First, the high-yield dilemma. 2, anatomy of an auto-callable. 3, the 70% barrier risk. 4, managing the downside risk. And 5, a calculated income gamble.
Starting with Section 1, the high-yield dilemma, chasing income in a low-yield world.
So the fundamental pain point for investors right now is that traditional bonds and equities just aren't cutting it for income-hungry portfolios. To put this in perspective, the S&P 500 pays out that 1.3%. The U.S. Aggregate Bond Index gives you about 4.6%. Even if you push the very limits of traditional risk and go into junk bonds, you're maxing out around 7.4%. So when an ETF targets 14.6%, yeah, it's safe to say this income isn't coming from standard corporate dividends. It's coming from something completely different.
Enter the Trojan horse solution. We're talking about auto-callable ETFs like Innovator's ACI and ACII funds. These products are specifically designed to generate equity-linked income, targeting anywhere from 11 to 15% yields without taking on traditional interest rate risk or credit risk. Instead, they actually derive their income from equity market performance and volatility using some pretty complex derivatives.
Moving right along to Section 2, anatomy of an auto-callable. Mechanics of the trade. Now, to truly understand the risk here, we first have to understand the machinery. Let's define the jargon real quick. An auto-callable instrument is essentially a structured contract, typically an over-the-counter swap agreement. A really simple way to conceptualize it is to think of it kind of like a bond that pays coupons and returns your principal, but only as long as the underlying market doesn't crash through a specific trapdoor. If the market stays flat, goes up, or even drops slightly, you get paid. But that word conditional, it is doing a lot of heavy lifting here. And this brilliantly illustrates what I mean. Looking at the payoff profile, as the market goes up, your gains are strictly capped. You only get your defined coupon, no matter how high the stock market rallies. But if the market drops, it acts as a buffer for a bit, until you hit that terrifying steep drop-off on the left. If the market falls past a certain point, the floor literally falls out, and you suffer severe losses. Mechanically, this whole setup relies on 4 key components working with basic if-then logic. First, you have the reference asset. For the ACEI ETF, this is the top 10 largest U.S. stocks. Second, the coupon barrier, which is your income threshold. If the stock is above this line on an observation date, then you get your income. Third is the maturity barrier, which protects your principal, again, if the asset stays above it. And finally, the auto-call threshold. If the market goes up too much, the contract is automatically called or redeemed early, and you just get your money back to reinvest. Which brings us to Section 3, the 70% barrier risk, when the floor falls out. This brings us to the absolute core focus of today's explainer, the massive caveat hiding right beneath that juicy double-digit yield, 30%. That is the magic, or, well, maybe tragic number here. These funds utilize a 70% barrier level. This means the barrier is set at 70% of the asset's initial value. So to put it simply, it takes a 30% drop in the underlying reference asset to breach that barrier. If the stock drops 10%, 20%, even 29%, you are totally fine. But the very second it drops 30% or more, everything changes. According to the evaluation table in the Innovator Prospectus, if, on a coupon observation date, the reference asset is valued at less than that 70% coupon barrier, the payout is zero, no coupon payment is made. And even worse, if we reach the end of the contract, the maturity date, and the reference asset is still less than that 70% maturity barrier, the prospectus states you will take a 1-to-1 principal loss. You absorb the entire drop of the underlying asset, offset only by whatever little coupons you managed to collect beforehand. So the crucial point is really understanding this domino effect. Imagine a severe market drawdown, like a tech bubble bursting or a major financial crisis. Step 1. The reference asset drops more than 30%. Step 2, the 70% coupon barrier is breached, meaning your high-yield income stream instantly vanishes. Step 3, if the asset doesn't recover by the maturity date, that maturity barrier is breached. You don't just lose your income, your underlying principal suffers a 1-to-1 loss with the market. And remember, you've had your upside capped this entire time. So let's look at Section 4, Managing the Downside Risk. The laddered strategy. Now, ETF providers aren't oblivious to this risk. In fact, they specifically engineer these funds to try and defend against a single 30% drop, wiping out the whole portfolio. They do this through a laddered portfolio defense. The fund doesn't just buy one single auto-callable instrument. It holds multiple over-the-counter swap agreements with staggered maturities, maybe 2-year, 3-year, and 4-year tenors. Because they're laddered, they all have differing observation dates and maturity dates. This means if the market has one terrible month and drops 30%, it might knock out the coupon for a fraction of the portfolio, but it won't immediately wipe out the entire fund's income or principal at maturity. It basically softens the blow of a single bad day. And we really have to look at the historical context to ground this risk. According to data provided by Innovator across 24, 36, and 48-month periods, major index losses of more than 30% have occurred only 3.3% of the time. Now, for the top 10 individual stocks, that risk is a little bit higher, about 10% of the time. So mathematically, a 30% drawdown over a multi-year period is relatively rare. But rare does not mean impossible, for sure. When broad economic crises hit, that 3.3% probability becomes a very harsh reality. Finally, Section 5, a calculated income gamble. Is the yield worth the risk? Now, what's really interesting about this slide is the sheer asymmetry of this trade. It is wild. You are explicitly trading away all of your positive market upside. If the S&P 500 rallies 40% in a year, you don't see a single dime of that growth. You only get your capped 15% yield. In exchange for completely forfeiting that growth, you get a 30% safety net. But as we've just seen, it's a remarkably fragile net. If the market drops 31%, that net breaks and you just fall all the way down with it. And we absolutely cannot emphasize this enough. I literally want to read this stark warning verbatim from the Innovator Prospectus itself. Funds shareholders can lose money by investing in the fund. The fund could forfeit the entire notional exposure. You guys, this isn't just standard legal boilerplate. It is a structural reality of the barrier risk. If the underlying reference asset goes to zero, the auto-callable instrument goes to zero, plain and simple. Which leaves us with this final provocative thought. As you evaluate high-yield income streams in your own portfolio, you have to ask yourself one thing. Are you truly willing to trade away all of your market upside for a 15% yield, knowing there's a 30% trapdoor waiting at the bottom? It's a fascinating structure, no doubt, but it requires a crystal clear understanding of your own risk tolerance. Thank you so much for joining me on this explainer today. I really hope it brought some clarity to a pretty complex topic. Keep learning, and I'll catch you next time.